about is plenty of volatility in the markets. Even before the latest escalation of the conflict in the region, the price of other metals like platinum and silver have been rising too. Vivek Dhar is Director, Mining and Energy Commodities Research at Commonwealth Bank. Vivek, welcome back to Fear and Greed.
My pleasure.
I want to talk about oil and gold and platinum and silver, but have you, in your experience, seen such a volatile period for commodities?
Look, in terms of how this year has started, I would say there has been so much volatility. Like, look, it's not that oil is any stranger to that beast. Like, if we go back to what happened in the Ukraine war, then we had the Israel-Hamas war in late 2023. This is all like something that oil gets used to, but it certainly is something that this week it really has become another risk that we're all considering. And this is on the back of having to deal with everything on the Trump tariffs. So, if I had to say, this commodity complex has gotten used to volatility, I just thought it would have a breather by now, but it just doesn't seem to be the case.
So let's talk about oil. It's been relatively low prices in recent weeks, in part because OPEC and Saudi have suggested they're going to increase production going forward. Then we had the crisis in the Middle East, the latest round of the crisis in the Middle East is how we should put it. Is there any way of knowing where it goes from here? I mean, maybe that's asking the impossible question, but how do you think about it?
So look, in terms of how we've analyzed it, and as best as we really try to look at it, is that when we think about who has been the primary driver of oil prices, it has very much been OPEC Plus and their strategy in terms of setting a price which is conducive to their longer term view of the market. Now, if you told me last year what oil prices were OPEC Plus really trying to target, as a group, I would have said something for Brent futures at about $70 a barrel. But what became clear this year, particularly on the back end of what Trump's policies were doing on the demand side, we saw OPEC Plus embark on a strategy where they said to the market, we're going to punish those members in our group that are producing more than what they have said. And in that, they then did this unusual move of boosting production a lot more rapidly than people thought. Now, I look at what OPEC Plus has done, and I don't see it as punishing the overproducers. I see it more as they are almost looking at a new price level, which they think is sustainable in the future. And I think that is closer for Brent between $60 to $65 a barrel. And I'd say that's been the dominant driver. And then now this whole situation with Iran has been the key risk in our view, upside risk for pricing. And this is something that has really become now a big topic, and prices, as we currently sit here, hover around $75 a barrel.
Iran is a major oil producer, but what is occurring between Israel and Iran at the moment, it kind of affects the other producers too. Is that right?
Yeah, absolutely. Look, I think the way to look at the levels of escalation, where the concerns have really sat, is Iran is a country that has been sanctioned heavily in the past, and that has resulted in their oil exports plummeting. But what we saw through the Biden administration was they were quite lax in enforcement, and Iran's oil exports, which predominantly go to China, lifted to about 1.5 to 2 million barrels a day. Roughly, we're talking 1.5 to 2% of global supply. Now, when we look at what's happened now, right, is that so far enforcement of US sanctions and talks about what is going to happen with US and Iran in terms of the nuclear accord and what does Iran need to do to comply with what the US wants. So far, that has gone nowhere. But the risk that everyone was worried about was enforcement of those US sanctions, which would limit Iran's oil exports. A direct attack on Iran, one which Iran sees as this is a threat to the Iran kingdom and the state and what it can do, it opens up the door to a lot more supply disruption in the region. And what everyone is worried about is particularly the key waterways that Iran controls. So it exports, like say, 1.5 to 2% of global supply, but the Straits of Hormuz, which is a very narrow waterway, that controls about nearly 19% of global oil supply. And so because of that control of that key strait, that is a risk that opens up, that everyone is now thinking, is this something we should be pricing in? And that's where the volatility in oil can be quite severe. Now, we think of that as a last resort, but clearly, if you start attacking nuclear sites in Iran, you can't help but feel that there has been a significant escalation in the entire, Iran-Israel relationship.
Stay with me, Vivek. We'll be back in a minute. My guest this morning is Vivek Dhar from Commonwealth Bank. Before the break, Vivek, we were talking about oil. Gold. It's hard to say a gold price of 3,300 or more has come off the boil, but in a sense it has kind of tempered somewhat, though late last week, Friday last week, it rose again.
That if we look at what has happened with gold, the biggest driver has been safe haven demand. And we talk about safe haven demand historically, and it's something that traditionally we've been like, this is positive for a number of asset classes. And gold has benefited from this, but what has made it very different this year has been its position in the batting order. If I go back to the global financial crisis in 2008, or I go to the pandemic in 2020, what we saw was, yes, gold was a safe haven asset, but it was under US dollar and under US treasuries. So what has changed this year is because of Trump's policies and a shift away from US assets, we've actually seen gold get promoted to number one. And that has seen gold really surge to begin the year. And that's a key reason why, even if we look at the current situation playing out between Israel and Iran, gold has benefited from that. And it is something that we think will be the case going forward. So right now, prices are, we're talking above $3,400 an ounce as we currently sit here. Our view is that this tailwind on safe haven demand can lift it by the end of the year to about 3,750.
Wow. So is that the story on commodities like platinum and silver? Are they kind of being dragged along?
Look, I would say what separates gold from platinum and silver is that on the gold side, it is very much safe haven demand and central bank demand hopes, which have been really strong tailwinds in terms of that price story. But with silver and platinum, they actually play also into the industrial commodity space because such a large component of demand is comprised of industrial. So you look at silver, say the photovoltaic industry, they use quite a bit, and we're talking overall, the whole industrial side, say it's 50% plus for silver, and it's closer to 65 to 70% for platinum. So in terms of what really drives, at least when we talk about silver and platinum, and what makes it very unpredictable as well, is it's also a call on what's happening with the macroeconomy. So if you move from deep recession fears and safe haven demand is strong there to one where you think actually the global economy will be okay, that actually gives a good tailwind into silver and platinum. And that's really what we're seeing is if US data holds up and global data holds up and we see Trump walk away from the threats of tariffs, if you look at it incrementally, that's more beneficial to silver and platinum than gold.
Okay. Then finally, battery metals generally, we have had Donald Trump saying that they're close to a deal. The US and China are close to a deal. Rare earths comes into that. Again, how do you play some of those lithium, rare earths, some of those sorts of commodities?
Look, I would say both are very different risk categories. If you look at rare earths, it's very much more a play on defense and defense spending and the rearmament of we're seeing globally. And so there is a need to have secure supply chains, and that's been the really big push. So any restrictions that China puts, we're going to see pricing increase ex China because of those restrictions and fears of those restrictions. What we're seeing in lithium, though, is a very different story. Like we've seen lithium come off, and it's come off quite a bit. But if we truly play out what's been pushing it, it's an EV price war that has really started now with BYD in China. So, we saw this last year, and this also led to lithium prices dropping. But I can't stress how an EV price war, even though it's the other end of the supply chain, it forces margin compression all the way from that EV side to battery makers, then to the upstream chemicals, and then finally to the commodity. And so that is the risk that we're facing. And eventually, the cure for low prices is low prices. So this should start seeing lithium demand pick up. that margin compression story, so far, that's been the dominant player.
We're totally out of time, but I have to ask you, because we're in Australia here. You're in Singapore nowadays, Vivek, but we're in Australia. Iron ore. What's the outlook for iron ore?
Yeah, look, our view on iron ore is that it'll average about $95 a ton
Right.
in the second half of this year, and that's very much where it's been. But I'd say the key thing to watch there is Chinese demand. And if we look at what Trump's policies have done, overall, it has meant that Chinese demand has weakened since the beginning of this year. And infrastructure and property, it has turned south. But what I think could be a positive surprise, and this is an upside risk to our forecast, is the composition and size of any stimulus in the second half of this year. So I would be watching, and this is across the industrial commodity complex, so base metals as well, is what does China do on the stimulus side? Because if you believe they're serious about getting to their target of around 5% growth this year, it's going to need stimulus in the second half of this year.
Vivek, thank you very much for talking to Fear and Greed.
My pleasure. Thank you.
That was Vivek Dhar, Director, Mining and Energy Commodities Research at Commonwealth Bank. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm